I had an excellent question come in from one of my viewers. What happens when momentum crashes? So, this viewer was saying, momentum's been doing really good in recent years. So, what's the catch? What does a momentum crash actually look like? Let's go back in time and look at the comparison between the S&P 400 mid-cap index and the momentum factor play on that index. First off, a momentum crash isn't what most people think. Momentum strategies, when they are based on an index, which sneaks in a certain quality tilt through the back door, they don't tend to fall more than the overall market does during a crash. In fact, they tend to fall the same amount or even a little bit less than the market overall. You can see this back during the Great Financial Crisis in 2008, where you've got the momentum factor represented by the blue line and the mid-cap index represented by the red line, trending along with momentum above the base index. And then when you get to the crash, the fall is actually comparable. For the S&P 400 mid-cap, the fall was negative 55.35%. And for the momentum factor, it was just negative 55.37% at the peak. Now, the underperformance or momentum crash actually happens in the early period of a recovery after an economic stressor event. So, starting in 2012, you can see that the S&P 400 mid-cap starts outperforming the momentum factor for quite a while. In fact, it stays that way until we get right up to 2018. Why? Because in an early economic recovery, trends tend to be choppy. The market hasn't decided which way it's going to go yet. Value is competing with growth. Everything's kind of a mess, and momentum is waiting for a trend to kick in. Now, that trend kicks in toward the later part of a bull market, typically. So you can see by 2018, the momentum factor captures the lead, and then it keeps the lead all the way up until the present. And in the long run, the mathematics says that the momentum factor will eventually just diverge from its base index and keep going and going and going. And the reason for this is, again, adaptability. You'll lag for a while for certain periods, but over time, the capability of swinging between value, between growth, between quality, etc., it benefits momentum and is the decisive factor for it pulling ahead. The other weird thing about momentum is it tends to get a boost from market stressor events. So even back during the Great Financial Crisis, when you had this dip, you could see that momentum for a while was coming out neck and neck or even ahead of its base index. Now, we got a really interesting kind of Goldilocks zone event for momentum with the pandemic, because it was a brief interruption in an existing bull market. So that market stressor supercharged the momentum strategy that was already following a trend in that bull market. And this isn't just a fluke. You can see that this same principle applies whether you're looking at small caps too. So right here we've got the S&P 600 small cap index, and you can see that the momentum factor trails for quite a long time, but as time goes on, it gets closer and closer and closer, and eventually gets neck and neck with its base index. Now, small caps tend to be a little bit more, shall we say, choppy, but that's okay if you are accumulating you would already be beating the S&P 600 small cap base index with that momentum strategy. So that's one thing to keep in mind. Momentum will often trail the base index after periods of economic stress until it catches on to whatever factor is going to be trending in a current market condition. So you pay a little price in terms of return for adaptability and long-term victory. And that's all there is to it, the momentum crash.